Well, it is the day of expiry, so it is the day of being choppy as well. 50 points lower back on the Nifty now, below the 24,950 mark as we speak. 70 points lower now on the index, in fact. So the bounce that we saw in the last few minutes of trade is now getting sold into. It'll be interesting to see what the final tick comes up to on the index. But Jyotivardhan Jaipuria from Valentis Advisors is now joining in with his top sectoral ideas and his views on the markets as well. Jyoti, good morning. Thank you for joining in. What do you make of this earnings season so far, where if there was a lot of fear that this would also end up being as bad as the third quarter was, but it does appear to be, it may not have been as bad as what the street was fearing.
Yeah, you're right. So, we started the earnings season with very low expectations. So that was a good thing. Because the expectations were low, earnings have actually been better than what the street was expecting. And so it's not like I would not call it a spectacular earnings season. At the same time, it's not been a disappointing earnings season. On the margin, earnings have, surprised positively. And I think, as we move into the uh, first half of FY26, hopefully we'll see a recovery coming. And this is like the start of some earnings pullback, which we see. We are thinking FY26 should be like a 11 to 12% sort of earning growth for the year.
So far, for the companies that you track, what's been the earnings growth in Q4?
The Nifty earnings growth is roughly coming around 6%, and there's still some companies to come. Some of the small caps which we have in our portfolio, they've been growing at closer to 13%. But those are very select bunch of people, so it's not like a broad base, probably representation.
In fact, you've been advocating that even though small caps are not cheap relative to the large caps, it makes sense to buy into the correction. That's been the strategy. So today, what percentage of one's portfolio should be in small caps? And can you share some small cap ideas or themes with us?
Yeah, so Reema, it all depends on the risk appetite of the person. So, I don't want to say this is what a percentage should be, but what you have to remember is this will be a very volatile segment. It's not exactly a cheap segment even today. So it's not like you're getting in and there's blood on the street. So you should have some allocation to small cap today, because that's where I think over the next 3 years, a bigger earnings growth will come. And so over the 3 years, they'll drive it. At the same time, it will be a very volatile segment. So essentially what you should do is use dips to buy small cap rather than this. And there are like a lot of interesting opportunities we can find in the small cap, which probably, within the engineering space, there are a lot more opportunities in the small cap than and the mid cap than you get really in the large cap, because there are niche engineering things right from pipes to transformers to, a lot of other smaller equipment which will do well. There are a lot of ancillaries to the consumer companies which do well, including the auto ancillaries and other people who supply to consumer companies, which you get in the small cap companies. So they trade much cheaper than what the consumer companies trade. And because they supply to not just one, but three, four of these larger players, then you tend to, hedge yourself against somebody gaining market share, somebody losing market share. So I think, there are a lot of niche opportunities which you get in mid and small cap, which probably are not there in the large cap, which one can look at.
Mm. If you are asked at this juncture, Jyoti, where are you going to put your money to work, where would you do so? And are there specific segments that you would want to avoid at this point of time?
For us, it is where is the risk, where's the reward, and essentially where is too much optimism. We tend to be very, very value conscious. So for us, banks has been one area which we have been investing in, and we continue to invest and like in the space. The other area which we've been nibbling at is the cement sector. Seasonally they don't do well in the monsoon, so that's really the time to build your position in the cement sector. We think once the monsoons goes away, then probably cement prices will go up and the sector's got consolidated quite a bit. The third area we've been focusing a bit on has been the chemical space. So chemicals is something which has got beaten down a lot. The way we see the macro, there was a lot of destocking happening from at the dealer level. That destocking is now behind us. And so we think that cement volumes will start to pick up and the pricing environment will remain more stable. It's a sector which is still not very, very cheap, but here there are a lot of niche and especially more mid-cap and small-cap companies which have a niche segment where, there's volume growth which is coming and there's pricing environment which is turning better. So these are three segments we are looking at. We continue to like the pharma segment, though, there's some concern on what, the US does, what Trump does on the tariffs over there. But that's a segment, again, on every dip which we want to really participate in.
In pharma, would you go with CDMO? That seems to be the favorite now for most.
Yeah, so we've been very early in the CDMO. We continue to like it. Valuations are no longer cheap over there, but I think the growth is going to be really tremendous. So probably most companies in the CDMO will probably double earnings over the next 3 years, unless something really changes on that pharma environment in the US, where a lot of tariffs come or they put some trade barriers. Otherwise, I think most companies will probably at least double earnings over the next 3 years. So you have to buy that growth, and we continue to like it.
You mentioned metals in one of your previous answers, Jyoti. There has been fair amount of resilience that China has shown despite the tariffs that have been imposed by the US administration. The industrial profit data that came in this morning was fairly good. Does metals remain a tactical play here, because there are too many moving parts surrounding the global economy here? So do you stay with this as a tactical play, or do you still find value here?
No, so see, metals, frankly, cement is the place we like, which is more domestic. Metals is very global. So for us, the worry is that the global environment is not great, and, global economy is probably going to slow down this year. So to that extent, we are not very excited about metal as a space. There will be tactical opportunities here because, these things really move quite a bit. So anytime that China really starts to show some growth in the economy, there'll be some tactical plays. But otherwise, metals are something which we generally avoid as a house. We don't really participate in it too much unless we get it at really beaten down valuations, in which case, we think it's good to buy and hold till the cycle, starts to do well.
One final question from my end, Jyoti. You mentioned banks as well, right? But just before I get to that, there have been two themes that have been at the talking point in the recent past. Defense has been one of them. And in line with defense, railway stocks have also moved higher after seeing the kind of correction that they had. So a lot of these defense names are at record highs again, be it the shipbuilding companies or names like HAL, which is not at a record high but has recovered substantially from the lows. What do you do in spaces like defense and in railways as well?
So, defense is something which over the course of next 5 years, 10 years, probably all these companies will become much bigger than where they are today. But, given where the current valuation is and given the optimism today, is something which, does not fit in our framework. At these valuations, we don't feel comfortable buying it because for us, we want a margin of safety. So, if something goes wrong here, just remember there's practically one buyer only, which is the government of India. And, if orders get deferred or the implementation gets deferred or, companies take time to implement, then, you suddenly start seeing share price corrections and they can be quite volatile. So we prefer buying a lot of these when, there's less optimism around it and the valuations are a little more cheaper.
But so you mean you would wait for a correction before you buy into these defense names, right, Jyoti?
Yeah, I would wait for the correction.
All right, Jyoti, thank you so much for sparing time and joining us today. Looking forward to having you more often on the platform. Jyotivardhan Jaipuria there of Valentis Advisors, by the way, continues to remain as choppy can be. At one point we were down 80, now we are down 50. So the bounce, the swings continue on the index, considering the fact that it is the sensex monthly expiry as well. Olectra Greentech still the top loser on the Nifty 500, but 6% lower on the stock. And giving it good company is Brainbee Solutions. That too is now down 6% at the lowest point of the day. The top two losers on the Nifty 500. Sagility continues to remain in a 5% lower circuit as well. The OFS opened for non-retail investors today and will open for retail investors in tomorrow's trading session. So a lower circuit for Sagility. Take your leave on this edition of Trading Hour. From Reema, me and the team that put this show together, thank you so much for watching. Halftime report on the other side.